Good afternoon, everyone, and welcome to the first quarter capital market review. The slides we will present will talk about the activities that we had in the first quarter of this year, January 1st through March 31st. Well, this quarter certainly has been a quarter of surprises. When we consider the stickiness of inflation and the debate as to when the Fed will actually reduce their tightening cycle, add to that the concerns we have over the banking system because of SVB and others, we've seen a market that has been surprisingly resilient. Yet a bond market that is talking about recession and some serious rate cuts at the end of the year to stimulate what would then be somewhat of an ill economy. We're not quite sure which way this will go. We have our opinion, but it's certainly been surprising nonetheless. As we typically do every quarter, we come up with a theme. And this quarter, the idea is when and where can we see opportunities? We do these capital market reviews quarterly because we think at the end of the day, the economy matters. And today we're going to dissect some of the major components of our economy. We'll talk about growth, jobs, corporate profits, certainly inflation, and also where the Fed is with respect to interest rates. Now we do this in an attempt to get a better understanding of where we are and also where we're heading. When we come up with our investment theme, we do so based on what section of the economy do we think we're in? Are we in a recession or recovery or mature market or an aging economy? And what is the Fed most likely to do? Are they friendly and they're loosening as they did at the end of 2021 and for a number of years before that? Or are they tightening as they have been this last year? We also think it's important to watch the Fed because the Fed is somewhat omnipotent. They will stall a perfectly good economy, and they will also stimulate an economy that is certainly struggling. So today's agenda, we'll touch on three key components. We'll talk a bit about the market and economic performance. We'll talk about the Fed and monetary policy. And then we'll talk a bit about diversity and balance in these difficult times. So let's get right into it and talk about the market and economic performance. Now, the last several weeks, it was somewhat of a wake-up call. The problems that we had with some regional banks, Signature, SVB, and others, caused some concern and some question about bank stability. The Federal Reserve and FDIC moved quickly and essentially walled off problems there. But it still lends itself to the question of where are banks in terms of their tier one capital ratios? How solvent are they? And the chart to the left talks about those capitalization rates. And you can see that they were high and increased during the recovery of COVID. Think of all the money being pumped into the banks that were kind of staying in savings accounts because people weren't able to get out and spend it. And then they've dropped off a bit here recently as the economy, let's say, has reopened and people are now enjoying spending and travel and such. And you can see that they've actually increased a bit over the most recent period of time. But the capitalization rates as they are today are vastly superior and much stronger than they were during the financial crisis, where they hit a near-term low. And today, banks are certainly far more capitalized and better capitalized than they were before. One thing that is happening now, and we've seen that recently, and it may very well have an impact in the future on economic growth, is that we're seeing a spike in the percentage of banks that are beginning to tighten lending standards. That's both commercial as well as industrial loans in large and middle-sized markets. And you can see where during COVID and then subsequently the reopening, those tightening standards were reduced quite a bit. And you'll see that on the chart to the right. And you'll see that since then, that chart is almost straight up. It's almost straight vertically up. And we're at a point now where clearly well over 40% of banks are identifying themselves as tightening lending standards. When that happens, that does have a negative impact on the economy. And we would expect to see a lag with respect to this. So this may cause further weakness in the economy as loans and spending tend to drive a lot of our investment as well as our consumer confidence. This chart reflects economic growth and the composition of the GDP. And you'll see that in the first quarter of the year, GDP dipped a bit, down 1.6% in Q1 of last year and down 0.6 of Q2. By definition, that is a recession, although no one has called it that, because the rest of the economy was relatively strong. But you can also see that we are certainly beneath trend. And the expectation is that we will stay beneath trend for a while. There's a lot of issues happening right now with respect to the economy. The banking turmoil is certainly going to create some additional bank distress and more tightening. Fed's interest rates, the hike on those rates, which tend to have a 9 to 12 month lag, more than likely will start to take hold and we'll start to see some friction. So the expectation is that number may continue to stay beneath trend and may actually go horizontal for a bit of time. And then we'll see an uptick as we work our way out of the recession. One of the surprises so far has been the relatively strong unemployment rate. Unemployment is nearly at its all-time high, or unemployment at its all-time low. It's just off of that mark. One thing that we have noticed, which is an issue that needs to be taken into consideration, is that now for 23 consecutive months, wage growth rates have been significantly underneath our inflation rate as well. And that becomes certainly an issue and becomes a problem. We would expect to see wage growth continue to diminish as more and more people come into the workforce. One thing about the unemployment rate, while we expect it to rise from where it is today, if we were to go into a recession, there's a lot of thought that it may not rise nearly as much because of the structural issues that we have right now with employment. We have a number of baby boomers that are retiring out. We also have a relatively strict legal immigration policy that's causing a restriction in the number of legal aliens that we have coming in to work. As a result, it's putting a constraint on the number of bodies available for employment. So we may very well have a situation for quite some time where we have more jobs than we have people capable of filling them. And that will put some strain on employment. And it may very well keep wage growth rates somewhat elevated for a period of time. Corporate earnings are starting to weaken. There's no ifs, ands, or buts about it. If we looked at earnings for 2022, they were down year over year about 13%. And right now, when we look at forward-looking earnings, the expectation is they should come in down about 6%. When you consider economic slowdown or recession and the impact that that typically has on corporate earnings, we feel that the current forward-looking earnings estimates may very well be too optimistic. And when earnings actually do come in and people realize the decrease that we're seeing in earnings and potentially a decrease in the earnings multiple, that could have a dramatic impact on market valuations as we move into and through a recession over the course of the next several months. One bright spot is that generally inflation is starting to come down. The huge increase in interest rates, nearly 5% over a period of time of just 1 year, is somewhat unprecedented. And it is having an effect. We are beginning to see some slowdown, although we're just beginning to see those cracks emerge. And as a result, it has an effect of slowing down economic activity and with it inflation. Now, we've shown over the years a number of these heat maps. Green is always good, red is always bad. A green color here would indicate a slowdown in the consumer price index or a component thereof. And a red box would indicate an increase in the consumer price index, things that would contribute to a higher CPI versus a lower, which is generally more preferred. And you'll see where we are at the far right. A lot of these colors are now greenish, lime green, maybe a little bit deeper green, compared to where they were, let's say, middle year last year. The exception is core services, and that's at the bottom quarter of the page, near the bottom, the last section. And you'll see to the far right, those are still quite pink. And that's an issue because that's the area that Chairman Powell and most of the Fed spends a lot of time looking at and analyzing. And the thought is core inflation will take a bit longer to come down. A lot of the improvement we've had generally has come from a significant weakness in energy. So we have to watch this because what that implies is until those numbers actually really start to come down, the Fed will remain on alert and will probably continue to raise rates for a period of time. So we'll need to watch this quite closely. Let's shift focus for a second and look at monetary policy. And again, monetary policy is basically the Fed. What are they doing with interest rates? What are they doing with money supply and so on? And we've looked at this chart time and time again. This is the Fed funds expected rate. I can remember several years ago where the rate was pancaked at the very bottom of this chart at essentially 0%. And we had a 0% policy for quite some time. If we look at the chart left to right and look at the far right, you'll see this huge, almost straight up increase. Those are the sum total of all the rate hikes that we've had just over the course of this last year. And then you'll see a couple of hash marks with descending rate expectations. And we're looking at essentially two colors, blue and green. If we look at blue, which is the outermost hash marked set of lines, that's really the FOMC's year-end estimates, their dot plot. And what that's suggesting is that the rates will continue to go up to about 5.1. That's their expectation of terminal rate, or the highest rate before they start to cut. And then they really don't expect to see a cut in rates until almost a year further out. And then those will be several rate cuts. And we're probably not getting down to 2.5% until sometime well past the year 2025. Again, in line with Powell's idea of higher for longer. That said, if you look at the green set of hash marks, those are market expectations. That's bond traders and such, other economists that are expecting a weakness sooner, with potential for rate cuts still this year. Now, that is not necessarily a good thing. What the bond market is saying, we're going into a recession. And the recession, which will cause a spike in unemployment and will cause a decrease in corporate profits and a decrease in consumer demand, will cause the Fed to reverse engines and start to stimulate to get us out of this weakened period by cutting rates. It should not be cause for celebration. But the market, bond market, and the stock market are telegraphing two entirely different things. What the Fed is doing with interest rates is not any different than what other major developed nations are doing as well. This shows, it's quite an interesting chart. The first one on the left shows central bank bond purchases. Most banks, like the US, are doing some version of quantitative tightening where they're going into the bond market and they're now selling bonds. You notice that the numbers now are below the horizon as opposed to buying bonds as they did for a number of years. And you'll see the Fed being both the largest purchaser as well as the largest seller. Now they're selling bonds. That's quantitative tightening. And when they sell bonds, they go into the market. They sell the bonds at a lower than market rate. As the bond price goes down, the yield goes up. So it's a way for them to also put pressure on interest rates, just the reverse of quantitative easing. And the other thing they do is when they buy, or I should say sell bonds, which is what they're doing these days, they take money out of the system. So there's less money out there. M2 is less. There's less money in the banking system to lend as well. So this is a very powerful tool along with raising interest rates. So it's a double whammy. And we really don't know how that'll impact the market. We can look historically and see the type of increases we've had. We can look historically and see what happens when yield curves invert. And all those things generally point to recession. What we can't calibrate is how quickly we get to a recession or how deep the recession may be, because we also have this overlay of quantitative tightening, which is taking to the tune of $100 billion a month out of cash and out of the banking system. But you can certainly see that every major power, US, Bank of Japan, ECB, Bank of England, essentially doing the same thing. The real interesting thing is with respect to rates, ECB, for example, and you'll see this in the second chart. If we look to the far left of the second chart, you'll see that their interest rates in Europe for a long time were below zero. You literally, it cost you money to have deposits at the bank. Not so much here in the US, we were always positive yield, and our rates were always higher than they were elsewhere in the world. So that lended to a lot of strength in the US dollar. And now we're starting to see weakness in the US dollar because for one thing, there's much more parity. Everybody has positive rates. And the delta between the aggregate rates is also much more in line. So when we look at the dollar drivers, I think we're coming off of a period where we had many, many, many years where we had relative US dollar strength. And now we're beginning to see some degree of US dollar weakness. Part of that will be certainly because of this interest rate issue, us versus them. But part of it also will be the fact that we should see some economic weakness rolling more into a recession, which will have an impact on dollar strength versus the rest of the world. That creates a situation, first time in a long time, first noticed it just last year, where international securities may very well have the opportunity to outperform US markets. Let's shift focus for a second and talk a little bit about investing across different asset classes or some degree of diversity. And I really just wanted to mention that when a portfolio is fully engaged, right now, to a large degree, we're quite defensive because of the unknown and not being able to calibrate just exactly how weak things could get. But it is important to consider when fully developed, when an account is fully engaged, that we have some degree of diversification. It tends to smooth out the ebbs and flows of the market. What I did want to mention, though, is if we look at the asset class returns year to date, and that would be the third stack of boxes from the right, you'll see developed international outperforming large cap US by quite a bit. And as I should mention, this whole issue of the market being up the first quarter is also quite interesting and surprising. Some of that is a function of tax selling. A lot of large technology companies were really beaten up in 2022, down 50, 60, 70%. And the way the tax laws work is you can sell that, and as long as you stay out of the company for 30 days plus one, you can buy back those shares. So now you have the same position you had before, but you can also realize and utilize the tax loss going forward. And you can roll that ahead or use it directly against other gains elsewhere. Very powerful. So it's not surprising that in terms of the tech world, we had a very sizable rally in January, which meant the sizable rally in the first quarter. And that rally in tech, because tech is so pervasive with the S&P, caused a sizable rally in the S&P as well. It did not indicate all systems are go, did not indicate relative health of the market, because 88% of the return from the S&P in the first quarter came from 14 companies. That was it. The Metas of the world, the Teslas of the world drove a lot of that because of tax loss selling, and then the subsequent buyback. So at this point, there's still really very little clarity. As far as the market and relative value, one can easily say that the market today is somewhat cheaper than it was at its all-time high. So if we look at December 31st, 2021, that was several months before the Fed started raising rates. At that point in time, they were still considering inflation transitory, interest rates were at zero. The Fed was still using quantitative easing to keep rates low. And the lime green that you see across the page would be those relative values. Now, what they're doing here is they're using something called the Z-score, which gives us the ability to look at relative values within many of these separate attributes. And we can now compare Z-score from one period to Z-score from another. And you'll see that in many cases, the dark green is somewhat below the lime green, meaning on a relative basis, valuations certainly are a bit cheaper. The black line that you see running across the page is effectively long-term average. So you'll see as an example that when we look at international securities today have they're much cheaper, meaning better value compared to where they were in the end of 2021. And where they sit today is significantly cheaper than the 25-year average valuation measure. And then as we move closer to the far right, you start looking at domestic US value, which is sitting on kind of the long-term average. US large cap, current valuations for both large cap and growth, think of that as tech and S&P, are quite a bit above long-term average, but certainly cheaper than where they were in 2021. Now, in 2021, the S&P was about a 20 to 24 PE. That was a historic high. Folks at that point who felt it was still reasonable and not problematic, suggested it because they thought no place else to go. Interest rates were at zero. The Fed's keeping rates low. Inflation is non-existent. Where else do you go to get a return? Now the market's north of 18 and a half times earnings, still way above benchmark with absolutely no clarity on where earnings will be or the health of earnings. Are they going to be $225 as the market is anticipating? Or are S&P 500 earnings going to be 190? Makes a big difference in terms of valuation. So something we have to watch, and also one reason for our conservative nature. Consumer confidence is also interesting. Confidence is waning a little bit from where it was, relatively speaking. It had moved up a lot in January and mid-February, and then with the bank shock, it's come back down a bit. And you'll see it's still quite low compared to historic standards. It may not be as low as we get during the cycle. If in fact we spill over or roll into a recession, confidence may drop again. But when that confidence does bottom, which it will, the recovery is really pretty spectacular. And we can talk about that in terms of market performance or relative value. You can also talk about it in terms of consumer confidence and sentiment. And historically, what it suggests is that if we looked at the 9 sequential peaks in confidence when everybody was absolutely enthused about participating in the market, the subsequent next 12-month return on the S&P was a paltry 3.5%. And conversely, when everyone is running scared and the confidence numbers and the volatility numbers are extremely low and volatility is extremely high, and everyone is scared and no one wants to buy the market, the subsequent 12-month return on the S&P over those 8 trough periods is almost 25% a year. So effectively, recoveries off of market bottoms can be very spectacular. So the key is not give a lot of it up going into a recession, so we have more of it available on the way back up. So again, our approach is we like to get 2 things right. We have to have an opinion on where the market is based on where we see the economy and where the Fed is currently. If you look at generally the large IRAs that we manage, our dynamic global balanced fund, it's not performed terrifically great the first 3 months. We didn't anticipate this rally. We think there's a lot of concern. Last year, it generally performed much, much better than the broad-based market, protecting a lot of downside. And we think we'll continue to see that trend as things start to unfold over the balance of this year. But one of the reasons we're quite conservative today has something to do with this chart, which we watch very closely. And you can see the most recent data is February. The March numbers should be out any day now. And they look at 12 key economic components and score those components based on, are they actually contributing to a healthy economy? Are they detracting from a healthy economy? Or in the case of yellow, is there some rate of change issue? Still growing, but at a much slower pace. And you can see there wasn't a whole lot to write home about come February. There was a lot of red. There was 2 greens. So that would be something like 9 red arrow axis. And the greens were trucking, which is somewhat of an oddity. I think some of that has to do with rebuilding from the shipping and the supply chain issues. But the other 2 are job sentiment and jobless claims, yellow and green. That in our economy today is somewhat of a lagging indicator. Again, we don't know how much unemployment can go up because there's so many jobs available and so few employees. But the other thing is a lot of the headcount reductions that we've seen here recently have, by their very nature, somewhat of a delay or lag as well. Normally, a big headline layoff is met with some internal severance. So there may be many, many months before some of those employees actually feel a need to reach out to and sign up for unemployment benefits. Just months ago, the thought was anybody could get a job anytime. Not so much, especially in terms of skilled trade. If you're a server in some degree of support, get a job anytime. If you're a mechanical engineer, electrical engineer, it might be a little bit tough because those same manufacturing companies are also pulling back on current hiring. So at some point, we expect to see those numbers increase. As I'm showing you this, you can see moving left to right, some deterioration, or I should say you should see improvement. So we're looking at this in reverse. But just to give you an idea of how quickly things evolved, by the end of 2021, September of 2021, all 12 were firing green. Couldn't be better than 0% interest rates, the Fed keeping rates lower, and really not a whole lot of inflation to talk about. And then it progressively got worse. And as such, the portfolios got progressively more defensive. Markets generally bottom out well before the recession does. Can't tell you exactly when that is. I already thought it would be earlier than we've seen today. But what we certainly expect is at some point, there will be a readjustment when there's a realization that there will be an impact on earnings, and that will have an impact on pricing. And the market will then bottom out to whatever it's going to bottom out at. The economy may very well bottom out later. There may very well be some continued weakness and reported weakness, all the while the market is looking beyond that. I don't think we're at that point yet with the market because there's still a tremendous amount of uncertainty as to what those earnings look like. But once we have a better sense, as we start to see some of that weakness and market valuations come down to something that's more like trend, then you would certainly see this ability to kind of look beyond. Remember, when the Fed raises interest rates, and they raised rates a lot, there's usually a 9 to 12 month lag. So a lot of the heavy lifting, a lot of the big rate hikes that we had last year and into, well, as recently as March, those have yet to have an impact. And as a result, we will see continued weakness in spite of the fact that the market at some point will take that into consideration. Not quite there yet. So we're watching this, we're looking at this regularly, closely, and making adjustments accordingly. With that in mind, if you know friends or family who have been approached with a voluntary severance, folks that would like to kind of sort out where they should be, how they should structure the portfolio in light of this uncertain economy, we'd love to talk to them. Simply have them visit www.kaydanwealth.com and click Get Started. Also, we will take them through this evolutionary wealth process, explore their possibilities, goals, expectations, help develop a game plan. And then if they're interested in working with us, we'll develop and execute our plan, and then regular continued follow-up. I also want to share with everybody the Retirement Engineer with yours truly. It's a podcast that we developed since our niche is mobility technology. We have a lot of folks who work in engineering, whether it's auto, aeronautical engineering, defense contract work as well. And as a result, we'll talk a lot about many subjects with respect to retirement and how you can help build a bigger, bolder retirement for yourself. This podcast, The Retirement Engineer, is available wherever podcasts are available: Apple, Google, Spotify, and many more. If you'd like any information about how you can sign up for the Retirement Engineer, reach out to us. Call the office at 810-593-1624, or again, visit us at kaydanwealth.com. And with that in mind, I'd like to sign off for this quarter. We'll talk to you again in just 90 days. Thank you so much for your attention. I hope this was helpful. If there are any questions, please reach out. See you next time.